I think we're good to go. Hello, everybody, and welcome to Selfwealth Live, the pre-recorded edition today. This is recorded on Monday, the 26th of the 5th, 2025, but it will be actually shown live to you guys tomorrow, or pre-recorded, shown on the 27th of the 5th, 2025. Something's popped up as normal in life, but that's okay. We just thought, rather than cancelling, let's get a pre-recorded session out so we can show you guys general overview of the markets once again. I'm going to bring up a few tickers that I have in mind, and I want Jason to have a look at myself. And then we're going to talk about a topic of discussion that's come up in my feed. Well, it comes up a lot, actually, and we're going to give it's all around active trading, active investing versus passive investing. Once again, there's always these two camps. Which one's better? Which you'd prefer? Well, I'm going to ask Jason what his thoughts are on these things, and why we choose to be active investors once again, versus just putting money in the markets every now and then and just hoping for the best over the long run, right? So let's get on to things as per usual. Jace, first of all, how are you today?
I'm good, Rog. I'm the reason we can't do live tomorrow. Something's come up in my world, so hence the pre-record. But yeah, generally good, and looking forward to talking about the markets, because they're really interesting at the moment. A lot of stuff going on, so we'll go through that and talk about some stocks. I love the question you got for later on. It's a really interesting one. So yeah, it should be a fun show.
Yeah, I hope people tune in, and I'd love to get some other people's feedback on it as well. Yes, let's get going now. I know we don't have a disclaimer to display on the screen, but Jace, if you want to just talk to it, and as everyone always knows, the disclaimer information is down in the description of this video. So if you really want a great read, then have a read down the bottom. The disclaimer's all there. Go for it, Jace. You can verbally talk about it now.
Yeah. So look, as all our regulars know, and any new viewers should know, everything today is general commentary only, no personal advice given. I'm not part of the Selfwealth SIFE team. I am Motion Trader. My business is Motion Trader. I've got my own licensing. You can get that on the Motion Trader website. And of course, as Roger pointed out, they've got a whole lot of disclaimer stuff for Selfwealth/SIFE below this screen.
Yeah, so Selfwealth by Scythe now. We've been for a couple of weeks now. It's been a good time, good couple of weeks. But the good thing about it is that we continue as a show, and we hope to generally once again continue, because we do have some great feedback around this show, and that's why we wanted to not cancel the show for this week, but at least give you guys a pre-recorded version of it. All right, so let's get into things then, Jace. It will be a little shorter than normal, obviously, because we don't have everyone's tickers this time around, but we do welcome everyone. Thanks for joining us. If you're watching us tomorrow, great to have you here. Jace, let's have a start off with the Australian markets. How are we tracking this week?
Okay, so let me get our screens up. So we should have the ASX 200 up there at the moment. And yeah, so the ASX 200, it hasn't done a great deal over the last week. It actually finished last week only a fraction below where it began the week. So really not a great deal going on there. But nonetheless, there's been some notable price action to discuss. So yeah, on the surface it looks quiet, but there's some important stuff going on. And that is that price is now starting to become established above the moving averages. You can see the moving averages below. I've got the 50 and the 100-day. The 50 is this red one coming up and just starting to cross over the blue one, which is the 100-day. And that's also something important to note, that the moving averages are crossing, and the faster moving average, the 50-day, is starting to get above the 100-day. You can see that's what it's like when you have a trending market. The shorter one rises above. So this is the first time in 3 months that we can say that the ASX 200 is above rising moving averages. And importantly, as I noted, the 50 being above the 100. You can't have a bullish trend without that condition being met. So I think that's an important development, that we're becoming established above the moving averages. We spoke about the potential for a pullback last week, and the reason for that was that we've had pretty much an uninterrupted rally over the last few weeks. And prices have been becoming stretched above the 50-day moving average. I'm going to quickly put on an indicator. We look at this a little bit when it's relevant, and this indicator shows the percentage either above or below the 50-day moving average the market currently is. So you can see here on the right-hand column, you see 4, that's 4%. So recently the ASX 200 has been about 4% above the 50-day moving average. So let me compress this and let me just draw a string line from 4%. Let's run it across. And when we do this, you can see that the ASX has been steady this week, and that's allowed this indicator to start coming back from 4%. And you can see over time, 4% has been a level which is pretty much as when the ASX 200 gets about 50 or gets about 4% above the 50-day moving average, it usually doesn't go a great deal further. Yeah, it can pop higher sometimes, but generally that's about as stretchy as the market gets above the average. And so with the market slowing down the last week, this has started to come back from that 4% level, but nonetheless, prices are still elevated in relation to the 50-day moving average, as you can see on this indicator below. This is still at its upper levels. Now, this often resolves in one of two ways. So the ASX 200, it could keep tracking sideways. Meanwhile, the 50-day moving average will catch up, and the indicator will continue to make its way back down to zero, which is where the two meet. And another way it could resolve is prices just simply pull back. Maybe they don't go sideways. Maybe they make their way lower, and that brings the indicator back. It's interesting to look at past situations when we get the ASX 200 being in a stretched position above the moving averages. So, like for instance, you can see these. See a couple of periods. We just jump back a couple of years. You can see that the ASX can stay elevated for a period of time. Like these, this is around like 4 or 5 weeks. You can get these periods where you do get the market just stays elevated for a few weeks, maybe up to a month or so. But ultimately the price does reconnect with the 50-day moving average. As you can see, prices got stretched, they stayed elevated, they came back, they rallied, they got stretched, they came back. So now it's going to be no different. It's just a matter of like when's the 50-day average and the price reconnect. And so I think this limits the upside potential just in the near term, and we're already starting to see this play out in the equal weight index. Let me just quickly jump across to the ASX 200 on an equal weight basis, and you can see the market's been tracking sideways over the last 2 weeks. It made a high in mid-May, and unlike the ASX 200, which has been grinding higher, the equal weight has been going sideways. And the equal weight's always interesting to look at because that's when we rank the top 200 on an equal weighted basis. The biggest company, the smallest company has the same pulling power in terms of driving the index. And just looking at the price action so far, it's been a shallow pullback. It's really been sideways, a shallow pullback. I think that's positive. This is a sign there's buying interest on the dips. That's what we want to see. We want to see this rally holding onto its gains and the buying interest coming in. Near term, there's some support. You can see this blue shaded area around 1,925. That stretches back to March last year. You can see it takes in a couple of high points, takes in a low point from late last year, early this year. So we've got a support there. Also coincides with these moving averages, which are turning higher. The equal weight moving averages haven't crossed yet, but they're getting pretty close. Maybe over the next week or two that we could expect that to happen. But they are turning higher, and that's an important point. As we've been discussing in recent weeks, for me, it's been a process of gradually getting money back into the market over the last 6 weeks. We've been talking about like coming back in using like ETFs initially at these lower levels, and then as the market's been rising, like looking for stocks which are starting to break back above their moving averages or rallying off their moving averages. And I think that remains the approach. I don't think now is the time to come in with aggressive buying. Just quickly coming back to the ASX 200, let's take our indicator off for now. I want to see how the ASX 200 does at holding on to its gains from the April low. Ideally, we see sideways consolidation or a modest pullback towards the averages. And I think if the ASX 200 can hold on to most of those gains, then the stronger the underlying interest is on buying the dip, and that's ultimately what we want to see for the potential of like higher levels later on in the year. But at the moment, I think constructive, Rog, and as I say, I think it's that gradual approach, bringing money back into the market when we get the right opportunities.
Yeah, look, I mean, as I've always listened to what you say, Jason. I mean, for me, I like the situation, and even though we have to be patient, I like the situation where it's actually consolidating a little bit. Now I've grown to love it, and because you don't want it to go too far backwards, obviously, but this whole consolidation going sideways and trying to keep hold of that support level is an important part of this process in a trending market, right? Until we find who's going to win the battle, the buyers or the sellers, right? So, but if it was to go completely backwards, then we don't want that, obviously. This whole consolidation period is actually a good thing to see these gains being held on to by the buyers, right? So, which is great situation to be in. All right.
Yeah. So we know the market isn't going to continue this upward trajectory at the rate it's been doing. That just doesn't happen. So it's a case of like, is it like what we want to see? We want to see up, and then when we get the consolidation, we want to see those gains, the market being able to hold those gains. It just shows that the buyers are coming up underneath and they're ready to start absorbing any stock which comes onto the market, as opposed to a situation where you get a quick, maybe short covering rally and the sellers are waiting at the top to start loading stock back into the market. That's why the pullback is important to look at and see how it's structured. Is the dip being bought or is the rally being sold? We get to see that as the next consolidation takes shape.
Yeah, fantastic. All right, let's have a look at the US market soon.
So the S&P 500, after that historic advance that we've had in the S&P 500, we're now starting to get the pullback, and this is the largest pullback we've seen in the S&P 500 in about 5 weeks. But having said that, given the extent of the gains that have been made, what we've seen so far, really, it's just a mild step back. We spoke about this possibility last week. When prices rally quickly and they pull away from the 50-day moving average, and this is particularly so when prices are below the moving averages and then they snap back to the other side, we often find that they, as we've been talking about with the ASX 200, they do then come back, pause, and pull back towards the moving averages. It happens so often, that sort of price action. Look, you can just see a little example here from August last year. Fell below the averages, snapped back above, and then pull back to the averages, stabilised and rallied again. I think the key now, it's what does this next pullback look like? Does it quickly find support and attract buying interest, maybe just above the moving averages or around the moving averages? Or is the rally quickly sold into, as we were just talking about a moment ago? For instance, like don't have to go back too far to find an example. Here's a good one. So the market, this is from June 22. Market was below the averages, quick rally back above the moving averages. So at this point here in August 22, it probably doesn't look that dissimilar to what we currently have, in that it's been a fast rally off the lows to above. And then what I would have been saying at the time was, let's see what the next pullback looks like. Does it find support or is it sold into? As it turned out, this one was quickly sold into. The dip wasn't supported. So it tells us that the environment's still not conducive to really re-establishing positions in the market. It's still a vulnerable setting. So that's what we get to find out on this next pullback. So that's going to be something we want to keep an eye on. From a bullish perspective, what I want to see again is that shallow pullback, prices holding above the moving averages, like really nice price action. Could be something where you get price action like such, where it just holds for a few weeks, doesn't do a great deal, but the selling, the limited selling is absorbed by the buyers, and then the buyers ultimately push prices higher. That's the sort of price action we'd like to see. And I think that would just help establish the S&P 500 above the moving averages, and then potentially set up that platform for another run higher. I want to show you something else. Let me just find it here amongst my indicators here. It's the volatility index. This is the volatility index for the S&P 500. They call it the VIX, the VIX, the VIX. And let me just compress this. You'll see I've got this blue marker across it at about 50%. Now, actually, what I'll do, let me put it on a weekly. I just get a bit more room on this screen. Now, I showed viewers of my strategy sessions this on Friday. I think it's really interesting to be aware of. So this data goes back to 1990. First time the VIX got up to 50 was in 1998, and you can see there've been a number of times, not that many. This is over 27 years or so. There's only probably been about 10 or so times where the VIX has got up to around 50 or beyond. And what's interesting, when we have a look at this, it's what we currently have is one of the fastest. So from being above 50 to coming back down to lower levels, this has been one of the fastest falls in volatility on record. And when volatility collapses in the manner it does, it typically doesn't make a quick comeback. So just look at these past spikes where the VIX has got up to 50 or above. This is during the GFC. This other big ones during COVID, and then we've got all these other notable events which have largely been forgotten from memory. But once you get these pullbacks, it can be a year or two or more before you get another big volatility spike. On this graph, show me two giant volatility spikes right next to one another. Closest we've got is from August last year, which was a bit of a panic sell-off rather than something really major, and then the recent tariff sell-off. But otherwise, they're fairly widely spaced. Yes, there can be some flare-ups. So you get a big decline in volatility. You can get a flare-up again. So it's not to say market can't go down, market can't get volatile. But what I think the volatility index tells us is that the main act is now over. And this opens a path for further potential gains in the coming months. It's not to say prices won't get volatile and we won't get highs in the volatility index again, but it generally doesn't happen straight after a big spike a few weeks ago. So, we could get an uptick, but I don't think we're going to be seeing a repeat of what we've just seen in the near term or in the next, even for the rest of this year, based on what we've seen in the past. Of course, the future can be different. Anything can happen, but the past it's worth being aware of. And looking for things which have never happened before. You can be waiting a while before they happen. I think that just coming back to the S&P 500, I think the play here is to approach the market from the long side, be looking for opportunities that stand out. So I don't want to buy just anything. I don't want to buy stocks which are falling below declining moving averages. So stocks which have some upward momentum to them. And then let's see how this pullback plays out. As always, I'm using wide trailing stops to try and see off any weakness. And if things do take a turn for the worse and we do start heading down, well, those trailing stops, that's how I can manage risk. I can then back out of my positions, take relatively small losses, and then prepare and be ready for the next uptick or the next upcycle. But at this point, yeah, we've got this momentum, the upside. We're back above moving averages. I think that's the path we want to explore for now.
All right, fantastic. Great. I'm glad you brought up the VIX there. A lot of people always like to see that, and I like to see it as well, I'm sure. So good view on that side of things. Let's have a look at the Hong Kong then.
Yeah, this has been generally positive price action. Prices continue to re-establish above the moving averages. Moving averages are still moving higher, or they've resumed their move higher after a bit of a sag, but they never actually turned lower and crossed. I think there are early signs that there's interest in buying the dips. You can just see these mild pullbacks over the last couple of weeks have been bought, and prices have maintained an upward slant. The key, as I've been saying with the ASX, as I've been saying with the S&P 500, the key now is how well the Hang Seng can hold on to the gains, and what this next pullback is all about. If prices can consolidate above the moving averages, we get sideways consolidation above the moving averages, then I think they potentially set up the platform for higher levels. I think it's a case of watching for now, but overall, I think it's generally looking encouraging, and especially so when we go over to the Chinese market. Now, I think this is looking quite interesting. Just look at this sideways movement we've had in prices over the last couple of weeks, coming back a bit today, being Monday, but generally they've been well supported over the last week and a half, and this is different to previous months because the market has actually been doing a good job of holding onto its gains. Just look at the other notable rallies since going back to last October. Big rally, market came straight back. Then in October, there's another attempt to rally, came straight back. In November, attempt to rally, came straight back, and so on. March, attempt to rally, came straight back. So this is the first time we're seeing a market that's rallied above the moving averages, and there is signs that it's trying to hold its ground. Let's see how the week ahead plays out here. But at the moment, we do have a shallow pullback above the moving averages. So that's a sign there is some interest in buying the dip. So rather than sell the rally, as we've seen many times or several times over the last few months, is the dip going to be bought this time? A little bit early to say at the moment, but there are tentative signs that's the case. There could be an opportunity developing here. So I think let's watch how this consolidation unfolds. At this point, I'd consider buying if we saw a breakout above the May high. So if this little dip today quickly stabilizes and prices break above the May high, I think that would be a worthy entry opportunity. Then potentially a relatively close stop just back below the moving averages. That's how you set up an asymmetric entry point into a trade. Go with buying to momentum. I'd be my play here rather than trying to punt a low, because this has been a market which has been prone to giving false signs. So see if we get that secondary break. But yeah, Rog, I think an interesting one to keep an eye on.
All right, fantastic. Now, a lot of stocks that we get asked by the viewers generally have to do with gold. So let's just have a look at that gold market in general. That's okay.
Okay, so I've got the gold price here, and we're starting to see gold rally off the 50-day moving average. I've been saying for I think you can see this strong near vertical rally that we had during April, and that's a concern for me when prices take off vertically, because vertical lift off in price usually isn't sustained, and you get pullbacks. And sure enough, we got that pullback. We got a classic zigzag pullback in the gold price back to the 50-day moving average. Now prices are starting to lift off there again. So it looks to me that there's a good chance we're going to see a new high in gold in the near term, maybe over the next couple of weeks. The way I'm approaching the gold market, it's to hold existing positions. So I've got positions in gold ETFs and individual stocks. I'm happy to let profitable trades run. I'm a little more cautious about putting new money into the market. I especially don't want to aggressively approach the market at the moment, because it is a market which has run a long way. This has been a big rally since October 23 to where prices are now. It's been a big rally, and there've only been a couple of relatively short consolidations along the way. So at some point there'll be a larger consolidation in gold. For now, the trend is up. I'm happy to stay in that trend, but I'm just wary about chasing stocks which have had exceptionally large rallies. By all means, I want to let them run, but I don't want to be getting overexcited after a big move is in place. I'm more cautious with adding at elevated levels.
All right, fantastic. Okay, let's get on to a couple of stocks that I was looking at. Obviously, we can't give you stocks today, so we'll just look at a few, and we might talk around how you would play these. Let's start off with IMB, if possible. Now, these have come up throughout the last couple of weeks as well, but obviously the structure's slightly changed now. Let's say you still wanted to get involved with these stocks. How would you play them, Jace?
Yeah, this is an interesting one. It's is it coming out of consolidation mode and preparing for a new period of rising prices? I like that it's flipped back across to the positive side of the moving averages, and the moving averages have started to turn higher. The 50 days back above the 100-day. I like that we've had this sideways consolidation above the moving averages. And then last week we got a breakout. So that was all looking good. In the last 4 days, we've had this pullback, which is a little bit steeper than I would have liked to have seen. I would have preferred we got price action, which was more holding on to the breakout. So you get the breakout and then holds on, moving averages catch up, and then you get another breakout. But instead, that hasn't happened. We've got this sharp move back down, which takes price back below this breakout point. So if I had this one, I'd still be happy holding it, because we've still got price above the moving averages, and this could all just be part of. It's just the sideways chop. Maybe it wasn't quite ready a week ago. Maybe this is all just part of building the platform for a larger move higher. So I'd be happy holding it. In terms of buying, if I wasn't already in this one, I'd just see how this pullback plays out. If it can stabilise near current levels or above the 50-day moving average, and then start to turn higher again, well, maybe that presents an entry opportunity. I think the price action is overall encouraging, but I just hesitate towards buying now, just because it's just quickly given back those gains that are put on last week. So a cause to just take notice and watch that, but maybe we are starting to lift out of this consolidation period. So I'd look on this with a positive bias, with an aim of maybe buying it if it stabilizes here and then we start to lift again.
Okay, fantastic. The next one's a situation I'm sure many people probably find themselves in. Now, this was a stock from last week, one of the viewers last week, and if you were holding it last week, you're probably a happy person right now. But let's say you were interested in this stock. How would you play this one? FML, please.
FML?
Yep.
Wow, well that has taken off. Yeah, so look, last week we had a nicely established uptrend. It was a stock, very happy to hold a stock in that sort of position. And I think when you're in stocks which are trending higher, you do put yourself in the position, I think you put yourself more likely to be in the position for these surprise upside moves when you have a stock which is trending higher. And that's what's happened here. It's surprised with a spike higher. You're more likely to get those spikes higher in a stock which is already trending higher rather than a stock which is in the doldrums and heading down. The spikes are more likely to be in the direction of the prevailing trend, which is down. But in this case, the prevailing trend was up, and that's where the surprise has been. Look, if If I was in this one, I'd be happy holding it. I don't know why it spiked up. Is it a takeover or it's some sort of announcement from the company? It's probably one I might find a little bit difficult to buy now, because like where do you manage your risk? Do you just take a punt and say, look, I'll buy here and put a 20% stop on it? But there's no structural reason for 20% other than it's 20%. It could be 15%, could be 25%. If you want to get the stop below some previous lows or back to the 100-day moving average, you're looking at like a stop of nearly 50%. So I think it's a harder one to manage risk on. So happy to hold a stock like this. If I was in it, if I wasn't in it, this one has jumped for now, and I'd have to just leave it, see what the consolidation looks like, maybe come back and revisit it in several weeks. But there's probably not a near-term entry level that I'd be happy playing with at the moment. It's not asymmetric in that it looks like I've got to have like a really large initial stop, and for me that's not how I want to play it.
All right. And just for what would the price action want to look like for you to be able to get into this stock in the future? Obviously, if it stays above EMAs, what kind of price action?
Maybe you get the classic sideways. If you get sideways, settles down for a bit, and the moving average is now catching up, it's like, well, okay, maybe you start getting a bit of a base, and you say, okay, well, I can buy current levels and have a stop a bit below the base, which seems to have established. So that could be a way to do it, but it's really hard to know until we see the price action. I'm just guessing at what the price action might be. It might look nothing like that. I'm just going to one of my favorite types of structures, which I think provides a good setup, but we don't always get a good setup in a stock like this. It could be months before something really starts to look at the chart and go, okay, I can manage risk around the new levels which have formed. Over the next few days, it could like rally hard again up to 52 cents, and then it could pull back down to 36 cents and just get broad volatility for a period. I don't think it's one we can sort of like set a game plan around, because at the moment we've just got one big spike higher on a single day. We're just guessing at what the future price action would be. So Other than just watch, I don't think there's a great deal more we can do. Other than, of course, if you've got it, I'd be holding it.
Yeah, of course. All right, good one to watch, obviously, over a certain period of time, see if it plays the way we would like it to. Let's have a look at the last one on my list at the moment. It is UBN. It's not traded a lot, but I just like the look of it. And what do you think?
Yeah, it's a motion trader stock. This one triggered a signal a few weeks ago. It's I think the overall chart looks interesting. It looks definitely has the potential of an ongoing upward trend. We're getting this bit of like prices got a bit stretched above the moving average a couple of weeks ago. Getting a bit of a consolidation at the moment. Maybe prices keep pushing from here, or possible we get another pullback and a bit more of a sideways structure. I don't know. We never know. It's if we were to get that sideways structure, that could really set up a nice buying point on a breakout above it. But we may not get that structure. So it's a case of like, just keep looking at stocks and just keep going, looking at your entry rules, looking at the price action, waiting for the right setups. You don't need to buy everything. Don't need to buy marginal trades. Just wait for everything to line up and then strike. At this point, I'd be happy holding this one. Doesn't trade very often. It is an illiquid stock, so that's a big factor for a lot of people. A lot of people won't be comfortable with that, and that's completely understandable. I like the many relatively small trades approach, so I might have a portfolio of 40 to 80 stocks. So I can establish positions in some of these less liquid trades. But even with that approach, like this really is at the edge of where I'd consider like the liquidity aspect of it. But Yeah, and sometimes these stocks which don't have much liquidity, they do go on to larger trends, and then as they continue to trend higher, liquidity does start to develop in some of these stocks. I've seen it happen. I've seen stocks with patchy price action, and then 300% later, they're reasonably actively traded. So just because it's liquid now doesn't mean it will always be the case. But of course, we don't know what its future holds. But yeah, Rod's an interesting one with potential.
All right, fantastic. Okay, so the third section of today now is the topic a little bit on my mind, obviously, and I'm sure it's on a lot of viewers' mind as well. Now, this was a comment left on one of our previous videos, and I'll read it out because I'm sure you're in a good position. I'll read this question out, but then I'll preface. I think you're in a good enough position now, Jace, to let your money do all the work and not have to do much of this anymore, right? So, what I want to do though is I want to get your thoughts on it and why you're such an active investor. But let me read out this comment. I'm sorry, but technical analysis is not predictive, which we know that. We know it's more around probabilities. As Warren Buffett points out, putting effort into technical analysis is the best way to fool yourself into believing that your work is productive. Buying and selling based on technical analysis is only 5% better than random behavior, but I suppose 5% is better than zero. No person ever got rich using technical analysis. So that's the first comment. The second comment is I'm thinking of the best strategy during a downturn is dollar cost averaging into an index all the way down. Is it the right way? So the similar concepts. I'll just leave the floor open to you, Jace. If you knew that you could just make 10% on all your money for the rest of your life, why don't you just do that instead of doing all this that we do?
Goodness me, there's a bit to unpack there.
There is.
Look, well, firstly, I've got to correct a misstatement. It's not true to say that no one's ever gotten rich, or words to that effect using technical methods. It's just totally incorrect to say that. I'll get a prominent example. So we all probably have heard of the Boston Red Sox. It's the Major League Baseball team in America. So its current owner, a guy called John Henry, he made his fortune, and fortune is the word to use. He made his fortune as an algorithmic trend-following trader. So it's what we talk about here. It's looking for trends. It's trading trends. It's letting profits run. It's cutting losses. It's being rules-based. It's being systematic. It's ignoring fundamental analysis. So the statement that no one's gotten wealthy down this pathway, it is incorrect. Warren Buffett does. No one's going to take pot shots at Warren. Warren's been amazing. He's the second or the third richest guy in the world, so no one's going to try and pick apart what he does. But he does fundamentals. He doesn't do technicals, so he's probably not in a position to critique technicals because it's not his forte. As we've used with the John Henry example, people would, fortunes on the other side could argue back, well, hey, that's not quite right. Technicals can help. And I think where a lot of people go wrong with technicals is that they try to predict the future. And they do things like Garn and Elliott Wave, which are predictive. They're trying to foresee the future. So there's the term a broad church. Technical analysis is a broad church, in that there are all sorts of methods that come in underneath it. There were people who were looking at sunspots and lunar eclipses. They come under the umbrella of technical analysis. It's kooky and it's out there, but it comes under that umbrella. What I'm doing, it's not that. I like the old school technical analysis. I find interesting. We look for consolidations and price patterns. We look at market structure around the moving averages, and then we can use rules. Momentum, identify opportunities, keep what's working, cut what's not working, manage risk in a systematic, calculated manner. There's nothing random about that. It's using statistics, using probability. So I look at my own portfolio over the last. So I set my own. So I do the motion trader service, and I thought, well, okay, I'll set up my own motion trader portfolio. So that's been running since I think it was September 2015. So coming up to a decade, and in that 10 years, I'm about, including dividends, I'm about double what the ASX 200 has done. So I've got significant outperformance. So I think that's over a 10-year stretch. That's probably not random, and it's probably a bit better than 5% better than random. So I'd argue you can outperform the market if you've got a good approach, and you can be consistent and you can be disciplined. A lot of people can't be consistent, and a lot of people can't be disciplined. So even though they may use a technical approach, they can still fail, even though they might have great ideas, because they're not consistent, they're not disciplined. So it's a whole lot of things has to come together to make it work. I think that for a lot of people, an ASX 200 ETF is the best approach, 100%. A lot of people shouldn't try to outperform the market because they emotionally it's too difficult for them, or consistency is not their thing, discipline's not their thing. They're good at other things, but the market just makes them too unnerved, and they're then prone to sell when they get panicked, and they get FOMO and they buy at the wrong time. And it doesn't matter whether they're fundamental or technical. If you got the wrong emotional setup, it's trying to do individual stocks and active investing. You shouldn't be there. You should be in an ASX 200 ETF. You should dollar cost average. It's a proven strategy over the long term. It works. I invest long term in ETFs as well. You don't have to be one or the other. You can be both. I actively invest with a significant amount of capital, and I also passively invest through ETFs. I can do both, and both add value in their own way. It's interesting. The ASX 200 is an average, so you get the market outcome. You get the average. Not everyone can be above average. You got an average. You got to have those on the high side and those on the low side. But for all those on the low side of the average, where does that money go? It goes to those who are on the positive side of the average. They're getting the outperformance. So that's where I aim to be, and I think I can do that through using the technicals, through using a portfolio with a strong stock bias. So buying and holding what's working, jettisoning what's not working, getting out of it. Like why do I want to be in an ETF holding stocks like Star Entertainment? I don't, maybe that's not even in the ASX 200 anymore, but as an extreme example, the ASX 200 has plenty of stocks in downtrends or not performing. If I'm using an active approach, I can cherry pick the best parts, and that's how I can get out performance. But of course, I'm still happy dollar cost averaging into some longer term ETFs as well. Spreading risk. That's what we do. We're risk managers. So I don't think it's a case of are you going to be fundamental? Are you going to be technical? Are you going to be a combination? It's about finding a process that works, that you can apply. That's a really important point, that you can apply. If you can't apply it, you can have the best process in the world, but it's not going to be any good because you can't operate it properly, maybe for emotional reasons. So that's what I think about all that, Rog. It's do what you want, but really people who knock approaches which are proven over decades, like so many very wealthy people who are purely technical. It's it's a bit silly to say, oh, it can't be done. No one ever got rich using a chart. It's just so not true. My whole career, I left uni in 1991, and I've made my whole career. I'm 54 and I'm 55. So from 21 to 55, my career has been based around looking at charts. And I think I'm outside the scope of random luck. It works. It works. Yeah. Whether you can make it work for you is another matter, but it does work if you've got the right emotional makeup and the right process structure for it to happen.
Yeah, a couple of great ideas in there once again. Having the two portfolios, one that's passive and one that's active, right? That's generally what, it's just a great concept to have. But I always remember listening to a video with Paul Tudor Jones is also a very successful trader in his time and over the 30, 40 years or whatever it was. But one of the things that's always been stuck in my head is the way he learnt was his mentor said to him, go and, go read this book on technical analysis. And once he did that, the mentor said, well, have you, read it again and then read it again, right? And obviously he was quite well known now for getting, doing really well in the stock markets using technical analysis, right? Just as an example, if you can find hundreds of examples of people succeeding, actively investing using technical analysis, then I think that a comment like that saying that something doesn't work, and I've heard prominent figures in Australia also say, hey, why would you bother doing this when you can just put money in the market because you're never going to beat the market, right? And I just think it's such a defeatist attitude to have, right? And you're also bringing everyone down with you, the people that are looking at you as a credible figure, and rather than showing people the opportunities that you could potentially have as an edge, as showing, so doesn't mean you don't have to do the passive stuff, but having the ability to be able to read charts, having the ability could give you an edge on the fundamental analysis side of things as well, right? So,
it's a bit of a cliche people use. They say, "Oh, you can't beat the market, can't beat the market." But that's what people who can't beat the market would say. So if you can't beat the market, just say, "Oh, you can't beat the market." But as we discussed with an average, you got below average, you got average, and you got above average. So you don't just have average and below average. So maybe some people can't be average or above average, so they say you can't beat the average, but you can. Doesn't mean you will, but it's entirely doable. You mightn't do it every year, but over a long stretch of time, if you've got a robust approach and you apply it consistently with discipline, it's entirely achievable to get a market beating outcome. It's some people just don't want to look at long track records of successful people, and it's hard, Rog. It's like everyone will have to make up their own decisions how they want to approach things, but to say it can't be done, I say to my kids, as soon as you say it can't be done, well, it can't. You can't do it. So you've got to approach things. You've got to have a go, and you've got to have a rigorous process for having a go. It's not just charging out and just doing stuff. You've got to have a plan and then execute it.
Yeah, and it's important, as you say, right? Once again, the plan, the execution. It doesn't matter whether you're just putting dollar cost averaging into ETFs or you're doing the more active investing. You still got to have a plan, and you still got to be able to stick to it, right? And that's where, as you said, most people go wrong over time. They don't stick to the dollar cost average. They don't, and in the end, it's the same result, right? Where they're looking at it over all these years, or even a short term, they stop doing it. Such short term mentality. Even as active investors, you've got to have a long-term view, right? You can't just go, this within 1 year hasn't worked, I give up. Then it's not for you, right? Because it's like any if you want to beat above average, you've got to do what the above average people do, right? So isn't that true to anything in life, I think, or anything, especially in something that you could potentially, like technical analysis and doing what we do, Jace, doesn't take a lot of time. It can take less than 15 minutes a day if you got the right system set up, right, just to review your stocks and rotate as necessary, right? But it does take time to learn, and that's the investment, is the learning and the continual learning, continual work on yourself, right? Which, as you say, you have to be above average in mindset to be able to achieve that. If you want to achieve average or below average, then obviously technical analysis or anything of great nature that can achieve above average results is not going to be for you, right? So but anyway, the idea about this chat, once again, I'm glad we got onto this, and I'm glad that person wrote that comment on it here, because it's coming up on my feed a lot. Why would you do this when you can just do that, right? Is to show that there's no right or wrong. When someone bags a system, it's because they haven't really tried the system out themselves, or they're listening to others who are, the others who have not been able to make success out of the system, or chosen not to make success out of the system. Whereas if I like a system and I like the way we do things, I'm trying to follow the people that are successful in that system. I'm looking for those, and maybe there's a bit of bias there, right? Because that's a concept as well. But find the people that are successful in your field that you want to go down, the track that you want to go down. And I guess that's going to lead me to this last question for you, Jace. As I said before, you probably don't need to do all this. What keeps you doing this whole active investing thing? Why do you, maybe it's a personal thing, Jace, for you, but why do you, I mean, I know you've got your business and it's the education around it, but why do you continue doing active investing after such a long period in the markets?
It's interesting. It's interesting. The markets are always changing. I'm always fascinated by all the different names of the stocks that come up and the signals. And this is often for the stocks outside the ASX 300. You got to do stuff. You got to do something. And like this is what I do. I look at charts and price structures and markets, and I think about them, and I look at how they're set up, and use risk management strategies. It's how old's Warren? Warren's 90 odd, and he's only just stepping down as chairman now. So he could have thrown the towel in decades ago. But you got to do stuff that interests you. This interests me, so I do markets, and there's also the satisfaction of being able to outperform the market. So it could just be all passive in the ASX 200 or whatever, but it's satisfying to look back at your portfolio every year and go, it's gone well. Look, I'm ahead of market. It's also more profitable to be able to say that as well as just being satisfying. It was interesting. I had someone asked me about a year ago or so. They looked at my portfolio, which was about double what the market had done over the previous 9 years, whatever it was at the time. And they looked at the NASDAQ and they said, was all that active stuff really, is it really worth it when you could have just put your money in the NASDAQ and got a better result? It's like, well, if I knew the NASDAQ was going to do that 10 years ago, sure, put it all on the NASDAQ. But I didn't know the NASDAQ was going to do that. So let's rule off right now, today, okay, which indice are you going to go 100% in for the next 10 years? Are you going to go all in on the NASDAQ for the next 10 years at 100%? Will it be the best performer? I don't know. Maybe it will, maybe it won't. Maybe it'll be a European index. Maybe there'll be a mining boom. It'll be the ASX 200. I don't know which one it's going to be. So it's just craziness to look at something in hindsight and say, you should have just gone all in on the NASDAQ. Yeah, well, while we're at it, why don't we just use the QQQ triple leverage NASDAQ and go all in on that? It's like you can't invest by looking back at what happened over the last 10 years. We've got to look at like what we're going to do now and how we're going to manage risk, and not with these crazy notions that we can invest with hindsight, because we can't. So have that process and apply it to US stocks or Aussie stocks, whatever you want to do, or if it's dollar cost averaging into ETFs, do that. And many different ways to do it. Look at the fundamentals if you like them, but there's no one way that it has to be done. Many different ways you can win the game, and I use the word win the game. It's not just draw with the game. Many ways you can win it, but it takes time, it takes work. I've been doing this for decades. The 10,000 hour principle, I think, is a real thing. We've done studies on it. 10,000 hours of purposeful practice. Me looking at charts, day after day in my 20s. I put my 10,000 hours in there so I can look at structures now, call up a chart, and I'll give you a quick viewpoint. But a lot of people couldn't do that because they haven't done what I've done for so long. So be prepared to do the hard yards if you want to try and win the game.
All right, fantastic. Look, I'm glad we talked about this, because as always, it's a topic of discussion a lot of the time, especially when I go to conferences and I speak to clients and they have strong views and I'm just in the middle, just listening and take everyone's opinion on board, right? Which is what we have to do. But if you love this show, if you love technical analysis, if you love active investing, doesn't have to be technical analysis as well, then keep going and hopefully you will succeed as well, right? But tell us in the show now, this is not live, right? So tell us in the comments below, why do you continue active investing? I'd love to hear some of the reasons, some of the motivations, why you continue rather than just doing the average, right? Doing what you could do quite easily, right? I love the point you just brought up there, Jace. Why don't you just invest in an index? But then we're never going to know if that index is going to act the same as what it did the last 10 years. We're never going to know that, right? Whereas with this approach that we do, we've got some control over what what companies we hold in our portfolios, right? So I love that concept there. But like I said, write a comment below, ask questions if you want to, but tell us your motivation. I'd love to hear, and maybe we can talk a little bit about in our next show next week. Jace, thank you very much for today for our pre-recorded session. Much appreciated. Thanks to the viewers once again for watching us. Hopefully we've provided some entertainment for today. Just remember, we are only for entertainment purposes. This show, with general guidance only. And everything we do is say, make sure you do your own due diligence and your own research on once again. All right. And thanks for coming once again, Jace. Thanks again, mate.
Hey, Rog, that's been fun. That was, really interesting talking about all that today. Hopefully it was interesting for our viewers, most importantly. And look forward to the next live show next week.
Fantastic. All right, everybody. We will see you on Tuesday next week, Tuesday, 12 p.m. Thanks a lot. Bye-bye. Bye.